Across the Lone Star State, the rhythm of real estate is changing. For years, Texas was defined by bidding wars, low interest rates, and homes selling faster than for sale signs could be printed. But those days are gone. The question now echoing across living rooms, boardrooms, and city halls is simple: when will things go back to normal? The truth, according to housing analysts, normal might never return. Between 2020 and 2023, Texas witnessed a once-in-a-generation real estate boom. Low mortgage rates and limited inventory fueled double-digit appreciation, reshaping the market landscape overnight. But by 2024, the surge began to cool. And today, as 2025 unfolds, the Texas housing market is moving toward equilibrium, a delicate balance between buyers and sellers. In real estate, equilibrium is defined by one number: 6 months of inventory. It's the line dividing a seller's market from a buyer's market. For years, Texas sat far below that line. Homes were selling above asking, often with multiple offers in days. But recently, things have shifted. Now, many homes sell within just 2 to 3% of their final list price. A subtle yet powerful signal that buyer confidence is returning and sellers are adjusting expectations. As one veteran analyst put it, the last 5 years weren't normal, they were an outlier, a historic anomaly built on cheap money and limited supply. From Dallas to Austin, from Houston to San Antonio, the market has cooled, but not collapsed. Appreciation has slowed, not reversed. This is the new normal, a market defined by patience, precision, and pricing that actually makes sense again. To understand where Texas is heading, we must remember where it's been. In 2020, as the pandemic reshaped the economy, mortgage rates fell to record lows. Millions of Americans suddenly had buying power like never before. Builders couldn't keep up, lots were scarce, materials cost more, and new homes jumped in price by more than 45% in just 5 years. For many first-time buyers, the dream of owning a home meant driving further from city centers, further from workplaces, and further into debt. This phenomenon became known as drive until you qualify, a stark reminder that affordability in Texas was shifting from the middle of the city to the edges of the map. Even as prices slowed, another challenge rose: higher mortgage rates. What once was a 3% loan suddenly cost over 6%. That meant families could afford less house for the same income. And while appreciation continued, it did so at a crawl, leaving many buyers waiting on the sidelines. But beneath the surface, the fundamentals remained strong. Population growth, job creation, and economic expansion continued to make Texas a magnet for migration. Even as the market balanced, demand never truly disappeared. It simply evolved. Investors continued to hold a strong presence in 2024, paying cash where financing became costly. Meanwhile, builders began offering incentives, rate buydowns, closing cost coverage, even price adjustments, all to bring affordability back into reach. And it's working. The gap between asking prices and final sale prices has narrowed. In most metro areas, homes now sell between 95% and 98% of their listed value. The frenzy has cooled, but the foundation remains steady. So what's next for 2025 and beyond? Experts forecast a slow but steady return to pre-2020 norms. Appreciation will be modest, between 3% and 3.5% annually, aligning once again with the state's 50-year average. That might not sound exciting, but for long-term stability, it's exactly what the market needs. After all, a stable market is a healthy market. As the calendar turns to mid-2025, days on market are ticking upward. In Austin, the median sits around 60 days, up from 56 just a month before. Yet prices and sales volumes have held steady, suggesting not a downturn, but normalization. Homes that are priced right still move. Those that aren't sit. The message from experts is clear. Price correctly and your home will sell. Mortgage rates remain the great variable. Late 2025 indicators point to only mild movements, perhaps a 0.25% rise or drop at most. That stability could mark the end of the most volatile rate cycle in over a decade. The 30-year fixed mortgage, has hovered between 6.5% and 7.5%, a far cry from pandemic lows, but manageable in historical context. For buyers, this means predictability; for lenders, confidence; and for sellers, a clearer understanding of what homes are truly worth. The rental market, too, is settling into a balanced rhythm. After a wave of construction between 2020 and 2022, new supply has tightened and rent prices are stabilizing. Delinquencies are low, retention is high, and most renters are now spending about 20% of income on rent, a sustainable ratio for long-term stability. When we zoom out, the broader Texas picture becomes clear. Stabilization, not stagnation; correction, not collapse. Inflation and job creation will continue to drive prices modestly upward, and as global inflation trends ease, the Federal Reserve's cautious optimism could soon translate to real relief. Already, mortgage rates have dipped slightly, some as low as 6.08% in recent months, a quiet but significant signal that confidence is returning. But beneath the numbers lies the human story: the families who waited through rising rates, the builders who paused projects, the investors who bet on Texas and stayed. They all represent a housing market that's not crashing, just catching its breath. So where are we headed? According to analysts, forward, but cautiously. Texas remains one of the strongest economic engines in the nation. Population growth is robust, corporate relocations continue, and the state's housing fundamentals remain unmatched. As one report concluded, based on key metrics: population, economic growth, and job creation, Texas will continue to outcompete much of the country for years to come. Yes, the days of double-digit gains are over, but maybe that's a good thing, because stability, not speculation, builds lasting wealth. And for Texas, that's the new definition of normal. In North Texas, a quiet optimism is spreading. After months of hesitation, something is shifting. Buyers are stepping off the sidelines. It began in mid-September when the Federal Reserve finally blinked. After months of pressure and speculation, Chair Jerome Powell announced a long-awaited cut, 25 basis points. It was small, but in a market gasping for momentum, it felt like a spark. Realtors across Dallas and Fort Worth began noticing subtle signs of movement. The phone started ringing again, showings picked up. Buyers, once paralyzed by high rates, were starting to look again. "I'm seeing more people getting off the fence," said Realtor Laura Bayer Cook. "The opportunities are starting to come back around. People feel comfortable both buying and selling again." Her words echo what many in the industry have felt for months: that confidence, not just affordability, drives this market. For sellers, the shift is equally important. Many who locked in record low mortgage rates during the pandemic found themselves trapped, unable to sell without taking on a higher payment. Now, with the Fed signaling future cuts, the financial math is starting to change. A small adjustment in rates can open thousands of locked doors. And as those sellers re-enter the market, they're bringing with them something the region desperately needed: inventory. In Fort Worth, inventory levels climbed to 4.1 months by August, up from just 3.7 months a year earlier. According to the Texas Real Estate Research Center, a healthy market typically holds between 3 and 4 months of supply. That number, though still modest, signals balance returning to North Texas housing. Enough homes to choose from, but not so many that prices tumble. Paul Epperly, president of the local Realtor Association, summed it up perfectly. "Having more inventory allows families to upgrade and leaves room for first-time home buyers to finally step in. It's a ripple effect. As move-up buyers list their current homes, first-timers gain access to properties once out of reach. That's how the chain reaction begins." But make no mistake, North Texas isn't surging. The pace remains cautious. Rates, though lower than before, are still high by recent standards. Mortgage rates peaked above 7% earlier in the year, then settled near 6% to 7% by late September. It's a decline, but still a far cry from the 3% rates that fueled the pandemic frenzy. That means affordability remains tight. And for many families, even a small rate shift can decide whether a home is within reach. Economists like David Quigley at the University of Texas at Arlington caution against reading too much into one Fed cut. A rate cut may make things more affordable, he said, but there are still supply issues, particularly in North Texas. He's right, even as more sellers return, the population boom continues to outpace available housing. Demand in Dallas-Fort Worth remains relentless, powered by job growth, migration, and the region's unmatched economic engine. Still, optimism is returning in the construction world. Builders like Mike Garabedian, owner of Garabedian Properties in Southlake, have already felt the momentum. The phone started ringing, he said. The lower rate is increasing demand for my homes, especially under the $2 million range. For developers, even a small uptick in buyer activity can mean the difference between holding land and breaking ground. It's a delicate balance, and one that builders are approaching with caution. Garabedian added, if rates dropped too much, demand would explode, and we'd see supply chains and labor get stretched again, and that means inflation. In other words, moderation is key. Too much fuel and the fire returns, too little and the embers fade. At Texans Credit Union, CFO Ben Hart agrees. He notes that mortgage rates aren't tied directly to the Fed's short-term decisions, but rather to the 10-year Treasury yield, a benchmark that moves on investor sentiment. In the weeks before the Fed meeting, those yields had already dipped, suggesting the market was anticipating a cut. In other words, the shift in psychology had begun before the announcement even arrived. For credit unions and smaller lenders, the challenge now is restoring confidence among first-time buyers. To help bridge the gap, Texans Credit Union rolled out new low down payment programs, as little as 3% down, to get more young buyers into homes. We wanted to make it easier for people to re-enter the market, Hart said. For many, this is the first sign of hope they've had in over a year. But even with optimism rising, the fundamentals haven't changed. North Texas still faces a supply crunch. A single rate cut won't rebuild the thousands of homes that never broke ground during the pandemic. That will take time and confidence that rates won't spike again. Until then, the market will recover slowly, fueled by cautious optimism and gradual momentum. Yet what's happening in North Texas may be a preview of what's coming statewide. A new cycle is emerging, one defined not by frenzy, but by flexibility. As the Fed signals more cuts ahead, builders, lenders, and buyers alike are watching closely. Because in real estate, confidence builds momentum, and momentum builds markets. It's not a boom, it's not a bust. It's something more sustainable. As one local builder put it, the Fed didn't just cut rates, they cut the fear. Across Dallas and Fort Worth, that sentiment is spreading. Buyers are browsing again, builders are quoting again. And for the first time in a long time, sellers are starting to believe again, a slow thaw, but one that could define the next chapter of the Texas housing story. Across Texas, a new chapter in housing is unfolding. The storm of the past few years has passed, and now, calm waters are returning. For the first time in a decade, the market feels balanced, inventory is up, prices are cooling, and buyers, long at a disadvantage, are finally gaining leverage. The data tells the story. In May 2025, home sales across Texas rose a modest 0.1% year over year. On paper, that seems stagnant, but after years of volatility, stability is the real victory. The home price index, flat, holding steady at 0.0% growth. No spikes, no collapses, just a pause, a breath, a sign of normalization. But while prices plateaued, inventory soared. Active listings jumped nearly 30% compared to the previous year. That's not a slowdown, it's a recalibration. Sellers are cutting prices to attract offers. Builders are scaling back on new permits. And buyers now have options, something unheard of just a few years ago. The Texas Real Estate Research Center reports that single-family construction permits dropped 8% year-to-date. Developers are no longer racing ahead blindly. They're watching the market and adjusting in real time. This is what a healthy correction looks like. Let's look deeper at the numbers. Median sale price across the state, $340,000, down 1.4% from last year. Days on market, 32 days, up 23%. And the median price cut, $11,500, a clear sign that sellers are recalibrating to reality. Gone are the days of instant bidding wars and all-cash offers over asking. Today, buyers negotiate and win. For first-time homebuyers, this shift brings breathing room. No more rushing to sign contracts within hours. Now, patience pays off. Buyers can compare, calculate, and choose homes that fit their budgets, not just their fears of missing out. And for sellers, the message is clear: price realistically or prepare to wait. Statewide, more than 65% of closed sales in May included price cuts of $5,000 or more. The era of overpricing is over. Presentation, condition, and value matter again. It's no longer about who lists first. It's about who lists smart. Region by region, the Texas story takes on unique shades. In Austin, home values have slipped 3% year over year, now sitting 17% below their 2022 peaks. After years of explosive growth, the capital city is finding balance. In Dallas-Fort Worth, inventory pressure has pulled prices lower for 3 straight months. Yet the fundamentals, migration, jobs, affordability, remain strong. Houston, meanwhile, is bucking the trend. Despite inventory buildup, prices there continue to rise modestly, up 2% year over year, and San Antonio tells its own story. Prices down 0.4%, median sale price around $310,000, and typical seller cuts exceeding $15,000. Every region is adjusting differently, but together they form the same narrative. A Texas market cooling into sustainability. The implications reach far beyond price charts. A market like this favors balance over speculation. It rewards patience instead of panic. Buyers gain time, sellers gain perspective. And agents, after years of frenzy, finally return to fundamentals, relationships, education, and trust. But what's driving all of this? The answer, once again, is interest rates. Persistent mortgage rates near 6.5% to 7% have kept affordability in check. Even small declines, a tenth of a point here, a quarter point there, ripple through the market like a soft breeze. Because in real estate, psychology is as powerful as math. A family who believes rates will fall buys. A builder who believes confidence is returning builds. And a state that believes in its future grows. Texas is still growing. Population, jobs, construction, infrastructure. These are the long-term drivers that will shape the next decade of housing. And while today's headlines may focus on rate cuts or price drops, the deeper story is one of strength, not struggle. The shift toward a buyer's market is not a crisis, it's a correction. It's the market remembering how to breathe again. For years, buyers were pressured to overpay, to waive inspections, to chase the frenzy. Now, they can make rational decisions again. And for sellers, this is a time for adjustment, not retreat. Homes that show well, that price well, that feel right, still move quickly. If the past 5 years taught us anything, it's that real estate always finds equilibrium. And Texas, with its resilience and growth, finds it faster than most. Even as the market slows, the foundation remains strong. Population inflows, business relocations, job creation. These are not trends, they're trajectories. Looking forward, economists expect slow but steady appreciation around 3% annually. A rate that might seem tame, but one that builds sustainable equity over time. For most homeowners, that's exactly what normal should look like. So where does that leave us? A Texas market at a crossroads, not of crisis, but of clarity. Buyers have options, sellers have incentives. Builders have discipline, and the Fed, by cutting rates, has offered the one thing markets crave most: predictability. But the real story isn't written in percentages or policy statements. It's written in neighborhoods, in families unlocking new homes, in builders breaking ground again, in for sale signs quietly turning to sold. Those are the moments that define recovery. The coming year will test the balance Texas has found. If rates stabilize and inflation eases, 2026 could mark the first truly normal housing year in a decade. Normal doesn't mean explosive, it means healthy. It means homes are valued, not chased, and in the long run, that's the kind of growth that lasts. Across the skyline of Dallas, the neighborhoods of Austin, the sprawl of Houston, and the quiet streets of San Antonio, a new rhythm is taking shape, a Texas housing market that breathes easier, moves steadier, and feels more human again. The frenzy is over, the fear has faded, and what remains is balance. That's where Texas stands today, and where the next chapter begins. The Texas market, balanced, strong, and ready for what's next. All the sources of information are mentioned in the description of this video.